Hello, good morning from my time here in Nigeria. My name is Pharmacist Jacob Dauda Gwari. I'm a trained pharmacist and a forex trader. Now, today I want us to look at two very important concepts in forex trading. That when you know about them, they could also help you in becoming a profitable trader. And these two concepts, they are called liquidity and volatility. What are they? Are they the same thing or are they different concept? Now, stick with me to the end of this video so as to know what liquidity is all about and volatility is all about and their importance. So, let's start by looking at this currency pair, which is gold, SAUUSD. Now, I just want to use this one to discuss about this liquidity and volatility. So, but then let's define what liquidity and volatility is and then look at their importance and all that. So, definition of liquidity. Liquidity refers to the ease with which an asset can be bought or sold in the market without affecting the price. Now, in the context of forex trading, it indicates how quickly and efficiently currency pairs can be traded. That's what liquidity is all about. And we have two types of liquidity. There could be high liquidity and low liquidity. Now, the high liquidity, the forex market is known for its high liquidity, especially in major currency pairs like Euro USD, USD JPY, GBP USD, major currency pairs. They are pairs that have USD attached to them. And you agree with me that they are one of the commonest currency pairs being traded you know. So high liquidity means there are many buyers and sellers, leading to tighter spread and more stable prices. Now, what I mean is that currency pairs, especially the major currency pairs that have high liquidity, it means that many people trade it. There are many buyers and sellers, you know, trading those currency pairs, especially the major currency pairs. And because of that, the brokers normally charge smaller spread. Now, the spread is the charges that the brokers charge. When you place buy or sell, before it gets to your green, it normally starts from negative. You will see red, minus something. So that minus something is what we call spread. They are simply the broker's charges. So currency pairs that have high liquidity, like the pairs that carry USD, that's the major currency pairs, the brokers normally charge small spread, compared to currency pairs that have low liquidity. Now, example of currency pairs that have low liquidity, currency pairs that do not carry USD attached to them. And let me give a simple example like the Nigerian naira. Um, is a currency pair that is hardly traded. So those kind of currency pairs, when you place a trade, the brokers tend to charge high spread because they are not often traded by many people. That's just a simple explanation. But the currency pairs that have high liquidity, especially the major pairs that carry USD attached to them, they are currency pairs that the brokers tend to charge low spread, low charges because many people trade it. There are many buyers and many sellers of such currencies. So the brokers tend to charge small spread. And like I said earlier, spread is simply the broker's charges. When you place buy or sell, the it won't just directly enter into profit, into green. It will start with negative. That's red. That negative that it start with is what we call the broker's charges or the spread. So, what are the benefits of high liquidity currency pairs? Now, high liquidity allows traders to enter and exit positions easily, reduces the risks of slippage, and generally result in lower transaction cost, like I said earlier, because many people trade those currency pairs. The brokers tend to charge low spread, that's low charges, and thereby there will be low transaction cost. So I hope you understand. I hope you are with me. So if in case you did not really understand what I've been saying, you can comment at the comment section. I will certainly get back to you. Now, there are factors that aid or that help, you know, in increasing liquidity of the market. Now, market hours is one of the factors that influence liquidity. Market hours. Now, liquidity can vary throughout the day, often peaking during the overlap of major market sessions, such as the London and New York session. Now, for me as a day trader, um, normally I trade the two sessions. I trade the London session and then the New York session. So I look for opportunity to trade in the London session and look for another opportunity to trade in the New York session. In a day, I only look for two opportunities, one in the London session and the second one in the New York session. Now, the London session starts from my time here in Nigeria. It begins from 8, and then the New York session starts from 1 p.m. So the London session has high liquidity because all banks, especially major banks and other banks, tend to, you know, tend to operate during that time. So there are many buyers and many sellers in the market. So that's why there's high liquidity in the market, because major banks, and individuals tend to trade such pairs at that particular session. That's the um, London session. And then the New York session too. Many people too tend to trade those sessions, so there's high volatility, high liquidity, I mean, pardon me please, high liquidity. So, but the highest liquidity is obtained when there's what we call uh, um, overlap of the London session and the New York session. Now, the overlap, like I said earlier, the London session begins from 8 to 4, down to 4, but the New York session starts from 1 down to 4, down to 4. Now, London session will be on, then New York session comes in by 1. So around that 1 to 4, there's high liquidity because there's an overlap between two major sessions, that the London session and the New York session. So when you're looking for liquidity, the highest form of liquidity is obtained during that period. That's from Nigeria. From that 1 p.m. down to 4 p.m., there will always be high liquidity because there's an overlap of two major sessions, that the London session and the New York session. So market hours really affect, or it influences liquidity. So liquidity basically, in summary, is the tendency of having more plenty buyers in the market or more plenty sellers in the market. It simply describes what liquidity is all about. When there are plenty buyers and plenty sellers in the market, then we can now say there's high liquidity. Now let's proceed to volatility. Now, volatility, in simple form, it refers to the degree of variation in the price of a currency pair over time. It measures how much and how quickly prices changes. That's volatility. And we also have high volatility and low volatility. Now, high volatility, a highly volatile market experiences rapid and significant price movement. This can be due to economic news, geopolitical events, or market sentiment. There are times that when you enter the market, you discover that the candlesticks form very fast, rapidly. It's very volatile, and especially when there's news, and the news carry the red symbol. If you check your um, this news event, you know, so you discover, if you check Forest Factory for news, and that's why it is advisable that we always check our Forest Factory for news and know the exact time there will be news release. Then we stay out of the market because of the volatility. Because sometimes if you forget to put your stop loss, the market may blow your account because of high volatility. So volatility means the degree at which the price of the currencies pairs move rapidly. That's volatility. And like I said, high volatility means that a highly volatile market experiences rapid and significant price movement. And mostly, high volatility is being uh, caused by economic news. When there's news release, you discover that the market will be so volatile. When there's a geopolitical event, the market will be very volatile. And when there are market sentiment around, the market will also be very volatile. So those are the things that brings about high volatility. So volatility means how fast the market moves, how fast the candlestick forms, and how fast the candlestick moves around. That's volatility. So the low volatility, when there are breaks like London, US break, when there's break, you discover the market will be very slow. So it is advisable to even stay out of the market because the volatility will be very slow. The candlestick will not form significantly. They will just be forming slowly, slowly, slowly. So it means that the market is slow. So when there are holidays, you discover that there will be low volatility. But when there are news events, you find out that the market will be so volatile, it moves very fast. So this brings about opportunities and risks at the same time. Now, high volatility can present opportunities for traders to profit from large price swings, large price movement, but it also increases the risk of losses. So if the market goes against you, and especially you forget to put a stop loss, you will lose significantly. So traders need to be cautious and may use strategies like stop loss orders to manage risks, of losing their account. So high volatility present opportunity. If your analysis was right and the market goes in your favor, you make a lot of pips. But should in case the market went against you, you are likely going to lose a lot of money, especially if you forget to put your stop loss. So you can see. And sometimes traders use indicators to measure the rate of volatility in the market. The common one is Bollinger Band. Use it to analyze market volatility. So basically, I can say in summary that liquidity and volatility, they are very key factors that influences trading decisions in the forex market. So high liquidity generally provide a more stable trading environment, while volatility offers both opportunities and challenges for traders seeking to capitalize on price movement. So understanding these two concepts helps traders develop effective strategies, you know, and manage risks effectively. So in summary, volatility and liquidity, they are two different things. Like I said earlier, uh, liquidity refers to the number of traders found in the market at a particular time. Like I said, the opening of London session to the opening of the New York session. London session is there will be high liquidity because many people are in the market, and when London session comes into, there will be so many people in the market. So when uh, there's when there's what do you call it? When there's overlap of the London and New York session, there will be more liquidity compared to only the London session and the New York session, you know. So liquidity simply, in a simple term, it simply means the number of people, of buyers and sellers in the market. The rate at which more of buyers and sellers are present in the market simply means liquidity. And then the volatility simply means the rate at which the candlesticks form or price movement or price move very rapidly in the market. And this can be influenced by economic news, geopolitical events, and market sentiment. So basically, these are just the two. These are the explanation behind the two concepts, volatility and liquidity. So with this one, we have come to the end of today's video. So if you have any question, please don't hesitate to ask me from the comments below. And then one of the peers that always present with high volatility, that is very volatile, is gold. Gold is very volatile. It moves very fast. And that's why mostly for beginners traders, it's always advisable that you stay away from gold. But you can also trade it, but you trade it with caution because it is very volatile. So it means that if it goes in your favor, you make more money. But if it goes against you, you lose more money very fast. It's very volatile. It moves very fast, you know. But things like GPP, USD, they are not too volatile. They are just normal, but not as volatile as the gold, basically. So we have come to today's video. Please uh, help me subscribe, like the video, watch the video so that YouTube can recommend to as many as possible. And whenever I release any educative video like this, YouTube can also recommend it to you. Thank you so much. And God bless you. Have a very pleasant day ahead. Bye.